The live stock price for Plug Power Inc., trading under the ticker PLUG on the NASDAQ, is $1.97 as of the moment of this script generation, reflecting a slight positive movement of plus 0.00%, or a few fractions of a cent today, sitting just above its intraday low of $1.89 and slightly below its high of $2.01. The immediate market action appears muted today, a quiet consolidation after a period of intense volatility that has become the defining characteristic of this stock. Now, here is the insight that cuts through the noise of the daily price action. Despite the relentless focus on the company's continuous cash burn and reliance on capital raises, the quiet yet significant news of a recent NASA contract for supplying liquid hydrogen up to 218,000 kilograms is a crucial, non-retail-driven validation point that gets easily overshadowed by the noise of its common stock woes. This isn't just another small order. It's a testament to the high-purity, reliable supply chain Plug Power has managed to build, which is a major, often underestimated factor in the highly specialized hydrogen logistics market. This kind of contract speaks to a level of technical capability and certification that the market typically dismisses when it obsesses over the quarterly losses. The general market expectation for Plug Power is a deep, almost existential tension. Investors expect it to be a key player in the coming hydrogen economy, a future where hydrogen fuel cells power everything from forklifts to data centers. Yet the grim reality of its balance sheet, marked by continual dilution, a large accumulated deficit of over $7 billion, and persistently negative gross margins, constantly weighs down the share price, keeping it firmly in the sub-$3 category. This price band makes it trade like a penny stock, even with a multi-billion-dollar market capitalization, a disconnect that forces a constant reevaluation. The prevailing narrative is that the company is a hostage to capital markets, using debt and equity offerings to simply sustain operations. The deeper reality, the contrarian take, is that the strategic movement on the capital side, specifically the recent pricing of a $375 million convertible senior note offering to repay high-interest debentures, is a necessary, albeit costly maneuver to stabilize the financial platform from which the massive green hydrogen infrastructure build-out is supposed to launch. It's an expensive ticket to the next phase, but a ticket nonetheless. The market tends to punish the issuance, viewing it as dilution, but one must acknowledge it cleans up a higher interest obligation, a crucial step in improving the cost of capital, which is everything in an infrastructure play. Looking at the recent stock movement, the announcement of this debt restructuring plan in November 2025 caused a significant pullback. The proposal to increase authorized common stock from $1.5 billion to $3 billion, intended to provide future funding flexibility, was met with predictable retail fear over shareholder dilution. This move is the classic expectation versus reality dynamic in action. The expectation is that such a move signals a desperate need for cash and an impending flood of new shares, crushing the price. The reality is that for a capital-intensive, long-duration build-out like a national green hydrogen network, this type of preemptive capital authorization is a pragmatic, long-term strategic requirement, not necessarily an immediate firing squad for the share price, though it clearly hurts sentiment. The stock has been highly volatile, with its 52-week range stretching from a low of $0.69 to a high of $4.58. This kind of swing is not indicative of a stable business, but rather a company whose valuation is entirely dependent on future policy, technological milestones, and, crucially, its capacity to execute its massive build-out plan. Trading volume today is sitting around 75 million shares, lower than the average of nearly 110 million. suggesting the current price stability might be a temporary lull rather than a fundamental shift in momentum. Institutional activity, however, shows a deep divide. While many analysts maintain a hold or sell rating with an average target price around $2.79, major institutions like Legal & General Group plc have been acquiring significant share blocks, indicating that at least some smart money sees value in the current distressed pricing and the company's physical asset growth. Plug Power's core business is centered on hydrogen fuel cell systems, specifically GenDrive, GenSure, and GenFuel. GenDrive powers material handling equipment, notably for major customers like Walmart and Amazon, forming their reliable, though low-margin foundation of their business. GenSure provides stationary power solutions, and GenFuel is their proprietary hydrogen fueling infrastructure. The real potential, and where the company is directing most of its capital, is in the GenEco electrolyzer business and the creation of a vertical green hydrogen ecosystem, a massive network of hydrogen production plants. This is the big picture, the reason the stock once soared to double-digit prices. In the last reported quarter, Q3 2025, the company showed a slight beat on the adjusted earnings per share, coming in at a loss of $0.12 versus a forecasted loss of $0.13, but revenue missed the consensus. The positive reaction in the aftermarket to this news, an 11.7% surge at the time, was a telltale sign that the market is focusing less on the miss and more on two critical factors: the improvement in operating cash burn, which was reportedly down by more than 50% from the prior quarter, and the strength of the electrolyzer business, which brought in $65 million, up 46% sequentially. This operational improvement, tied to the internal Project Quantum Leap restructuring, is the true reality defying the expectation of a perpetually mismanaged operation. It is a slow, painful process of optimizing a business model that is structurally designed to be cash negative until its massive, capital-intensive production facilities come online and scale. The hydrogen sector momentum itself is volatile, largely policy-dependent, with the U.S. government's Clean Hydrogen Production Tax Credit, the 45V credit, being the single most important external catalyst. Delays or changes to the final rules for this credit have a direct, painful impact on the stock, injecting significant macroeconomic pressure. Now, let's address the short-selling dynamics, which are a major element in the Plug trading story. Plug Power is heavily shorted. The latest exchange-reported data shows short interest as a percentage of the float is notably high, sitting in the ballpark of 23 to 33%, depending on the exact date and reporting methodology. The absolute number of shares sold short is significant, exceeding 300 million shares. This level is far higher than the peer group average and signals intense bearish sentiment. The short thesis is straightforward and compelling to those who hold it: an unprofitable company that will fail to achieve scale before running out of operating capital, leading to continuous, value-destroying equity raises. The short sellers, which likely include large hedge funds and institutional players betting on a fundamental business failure, are essentially saying that the dream of a green hydrogen network will be too expensive and too slow to materialize, and the stock will eventually be priced for liquidation or further significant dilution. The days-to-cover ratio, which measures how long it would take short sellers to buy back all borrowed shares based on average trading volume, has recently been sitting around 2.5 to 3 days. While this is not an astronomical number, indicative of an immediate catastrophic short squeeze, a situation that typically requires a days-to-cover figure above 5 or 10, it is still high enough to signal a coiled spring. Any unexpectedly positive news, like a major 45V credit clarity, a huge new order, or a surprising quarter of gross margin profitability, could force a quick covering rally. Retail investors, many of whom follow the short interest religiously on forums and platforms like Reddit, are acutely aware of this short pressure and often view it through a lens of manipulation, which fuels a potential squeeze mentality. It is crucial for retail investors to understand that short sellers often provide a valuable function by exposing fundamental risks, but their actions can also compound downward price pressure. When the borrow cost for plug shares spikes, a sign that supply is drying up, it suggests that the pressure on shorts is increasing, but these spikes are often short-lived. Actionable insight for investors watching the short volume is to monitor the failed-to-deliver data when it is released, looking for large spikes that can indicate settlement issues, which are sometimes associated with excessive or illicit shorting. Next week, keep an eye on the option open interest chain, particularly for out-of-the-money call options expiring in the near term. A sudden surge in open interest for calls